Okay, let's talk about crude oil. Ever since that May futures contract went negative, the background noise surrounding crude has just gotten so loud. I was actually afraid that anything we said about oil would kind of get drowned out. Now that the noise has died a bit, I want to show everyone, not just a forecast, but a blueprint or a roadmap that various Elliottians have used to track oil prices, not just for months, not just for years, but for almost 3 decades. So let's just dig in as usual with a chart. All of these charts, by the way, come from a book called Socioeconomic Theory of Finance. Specifically, this is chapter 22. If you have not read this book, highly recommend it. It'll help dispel a lot of the myths that prevent investors from being successful. So the forecast at the top of this chart was written way back in 1993 by an Elliottician named Peter DeSario. Peter was a commodities guy, real kind of technician. He actually kicked off EWI's energy service back in the 90s, and he made what seemed to be a simple forecast at the time. I'm just going to read verbatim here. Price should fall into the general area of $10 to end a fourth wave move from 1980 before the final leg up takes prices into new historical highs. Yeah, so simple forecast on its face, but I want to point out a couple things. First, Peter wasn't just bullish or bearish on crude, right? He actually made a two-step forecast, a decline and then a rise. That's a more difficult forecast than most analysts are willing to make. Second, he called for a specific price target, $10 a barrel, and more important, he didn't pepper that forecast with a bunch of if-then statements. Third, most important, he called for a historical rise in the price of oil, which by itself was a bold move at the time. Oil had gotten cut in half over the previous decade. So as an analyst myself, hats off to Peter. His was a detailed and a highly contrary forecast that took a heck of a lot of courage to make. So the question is, what was Peter looking at that gave him the confidence to make this forecast? Well, this is the blueprint I mentioned earlier. This is a chart of oil prices since 1859. That was the year the first commercial oil well was actually drilled in the United States. On this chart now, just to orient everyone, that previous chart from 1980, that's now just this little sliver of price action up here in the top right. And I'll just say at the outset that this chart looks like nothing useful until we put some wave labels on it. Once we do that, three critical things stand out. First, we see a corrective pattern that ended in 1910. That's the ABCDE over here on the left. Second, we see an impulse pattern since 1910. That's the price action between these parallel lines. Third, and most important, that impulse is not complete. We know it's not complete because impulses are 5 waves, and we can only count 3 waves at the high in 1980. This is essentially the blueprint that Peter was looking at. This is also the blueprint that guided other wave analysts for the next 30 years. And what's really cool is how this year's collapse plays into this pattern that was identified 3 decades ago. So before we look at the updated chart, let's walk through a couple of oil's big inflection points. Now, the book, Socioeconomic Theory of Finance, the book digs very deeply into all of our analysis throughout the 90s, throughout the 2000s. I'm going to skip around a bit just for the sake of time. Again, the goal here is to give everyone a taste of what is possible when you have an accurate long-term roadmap. And this next chart really kind of shows that roadmap, right? This is an idealized schematic of our model. This is where we've labeled oil's major inflection points by year. You can see 1910, 1920, 1931, and 1980. And the arrow here marks where Peter believed we were in 1993. Again, looking for a big bottom in wave 4 and then a historic rise to a lasting peak. So now let's skip a bit past that low. Wave 4 ended up bottoming at $10.35. So Peter's forecast was dead on. That low came in December of 1998. And we'll skip ahead to this chart that the Elliott wave theorist published in July of 2006. So this is about 8 years after the bottom. That 98 low, that's off the screen to the left, and we're rising in wave 5 now, and we've made a ton of progress, right? Oil has jumped eightfold now. Prices are $80 a barrel, and the theorist is tracking that final 5th wave, again, trying to gauge when and where it's going to end. Notice one really cool thing about the position we're at on this chart, right? It's actually a very similar position to where we were on that long-term chart. For example, we can count 3 waves up. That's the 3 in a circle here at the top of the chart. Also, prices are contained in a parallel trend channel, just like that previous chart. Also, we're expecting prices to pull back in a 4th wave. And finally, just as before, we are then looking for a final push to all-time highs in wave 5. So this is a really cool example of an Elliott wave fractal in action. The analysis is essentially the same, it's just that we're at a different degree of trend. Now, just a quick interlude here. We could spend hours talking about the psychology that developed around the oil market during this 3rd wave. The theorist noted a Newsweek cover about the price of oil here on the chart. It's around this time that if you were a halfway decent writer and you could knock out 300 pages explaining how the world was running out of oil, right, you were basically minting money. You had a fully captive audience. This is 3rd wave behavior. By the end of a 3rd wave, everyone has now recognized the trend and starts to pile on board. So now fast forward to the final 5th wave. Now we're in June of 2008. That 4th wave ended around $50 a barrel. You can see it here. It hits a trend line. The oil market is now a full-blown mania. Prices are at $130 a barrel when the theorist publishes this structure and calls for one of the greatest commodity tops of all time. You can read the full quote yourself here, but for a market analyst, this is the equivalent of stepping in front of a bus. And what's interesting is that this bus is moving exactly in the opposite direction as the bus that Peter stepped in front of 15 years earlier. It's the opposite side of the oil market, both in terms of Elliott wave patterns and in terms of investor psychology. Really interesting juxtaposition here. All right, so we're gonna fast forward a bit here again, but I just wanna show the initial drop in oil. Prices actually did not quite make it to the theorist target. We peaked about $12 short of that target. One more interesting thing here, this was an A-wave crash, right? If you haven't seen my earlier video on A-wave crashes in stocks, take a look at that one. This is the equivalent in a commodities market. And again, A-waves can be brutal. This one was a killer, 78% in 5 months. And one final thing before we skip ahead, even at this very moment in 2009, even after a horrific crash, a wave analyst knows a critical piece of information about the price of crude oil that no other analyst knows. And what they know is that the bear market is not over. And they know that because corrections trace out 3 waves, A, B, Cs. And all we've seen so far is the A wave. So without getting too bogged down in the wave model, Elliotticians know 2 things here. A B wave retracement is coming, and more important, they know that a C wave back down is still ahead. All right, so we'll skip ahead again. Again, socioeconomic theory of finance goes through a lot more of the real-time analysis of this decline and of the B wave rally that followed. I want to look at this inflection point here. It's now May 16 of 2011. We've seen that B wave rally. We've seen a Fibonacci retracement. We've seen that not just in oil, that's the bottom graph. We've also seen a Fibonacci level in commodities overall. So the top graph here is the CRB index. At the same time, the bulls have returned in spades, right? Insiders are calling for 200 a barrel. Experts say gas could hit $8 a gallon. A wave analyst, in contrast to nearly everyone else, knows that wave C is still ahead, knows that now is actually the time to get prepared for the next leg down. Now, take a look at May of 2014. We've skipped ahead about 3 years, but I don't want anyone to gloss over this 3-year stretch right here. This is a great lesson because sometimes markets exist for the sole purpose of frustrating everyone, right? The top was in, wave B was done, and prices just decide to drift sideways for 3 years, right? 3 years is an eternity in forecasting, and this wave structure turned out to be really tricky to analyze in real time. So in 2014, we're focused almost entirely on sentiment, what the theorist here called a deadly combination in sentiment. There were three things essentially we saw. One, we saw overwhelming bullishness among futures traders in oil. Second, we saw an all-time net long position among large speculators, while at the same time commercials, who are typically on the right side of oil prices, they were holding an all-time record net short position. So we said this was a deadly combination, and it turned out to be exactly that. This is crude updated through January of 2016, where the bear really gets going again. The crash on this chart is actually the center part of wave C, which happened over the course of 2015. So now we can really start to bring all of this analysis back home. STF was published in November of 2016. That was almost 4 years ago, right? Chapter 22 leaves off at this point in our schematic. All of the dates on this chart correspond to specific turning points in crude oil. Today, our energy analyst Steve Craig just updated the long-term chart in last month's GMP. It's pretty incredible. And what's incredible is that even with this year's crash, oil is just now testing the bottom of its trend channel, right? Understand something though, this chart is a little different than the first one we looked at. We're plotting average annual prices now, right? So from 84 to the present, we're actually using the average daily futures close for each year. The objective for prices is actually back near that cycle wave 4 low that Peter Desario was tracking nearly 30 years ago. It's a pretty incredible story that is coming full circle now. The big takeaway here is how an analyst, just by spending a few minutes to label a long-term chart with Elliott waves, how that can provide the context and the roadmap to forecast the price of oil over the next 3 decades. It's really an amazing story, and it's one that will only continue.